What is a liquidity event for startup stock options? Imagine holding a treasure chest of stock options from a startup, but feeling stuck because you can't access the gold until a certain moment. That moment is what we call a liquidity event. It's a key moment when shareholders, including founders, investors, and employees, get the chance to turn their stock options or shares into cash or other easily sellable assets. This is especially important for startups because their shares are usually in private companies, which are hard to sell. A liquidity event makes it possible to realize the value of those shares. Let's break down what this means. When a startup grants stock options, it gives employees the right to buy shares at a set price, called the strike price. These shares are often part of the compensation package to attract talent, but because the company is private, these shares are considered illiquid assets. That means they can't be sold easily for cash. A liquidity event changes that by creating a way for shareholders to sell their shares or options. There are different types of liquidity events. The most common is an initial public offering, which is when a company lists its shares on a stock exchange like the New York Stock Exchange or NASDAQ. Once listed, shareholders can sell their shares on the open market, making it a straightforward way to cash out. Another type is a merger or acquisition, where a larger company buys the startup. In this case, shareholders might receive cash or shares of the acquiring company, giving them a chance to sell or hold their new shares. Some startups also have secondary market transactions. These are sales of shares between private parties before the company goes public. It allows shareholders to sell their stock options or shares early without waiting for an IPO or acquisition. Additionally, some companies offer structured liquidity programs. These let employees sell part of their vested shares before an official exit, providing partial cash flow. Understanding these events is vital for startup teams. Stock options are a way to attract and keep talented employees, but without a liquidity event, those options remain just locked in. For founders and investors, planning for a liquidity event is part of their exit strategy, helping them realize returns on their investments. It also helps startups prepare for financial planning, including tax implications and how to distribute proceeds. In legal and operational terms, liquidity events are a core part of managing stock options and ensuring everyone involved can benefit. They shape how a startup grows and eventually rewards its stakeholders. Whether it's an IPO, a merger, or a private sale, these events are the moments when the value of all that hard work can finally be turned into real money.